Hello, welcome to another episode of Financial Tides. Today, we are going to be talking about credit scores. That's something that's really important, building your credit and how it's going to be used in your financial future. So, we're going to hop right into that topic with my co host, John, today. John, what is a credit score?
Credit score is just a prediction of how likely you are to pay back a loan on a time based on the information from your credit reports. Um,
Yeah.
it's quite
So, what,
simple.
what are some of the common credit scoring models like FICO, Vantage Score, and how widely are they used by lenders?
Hey, FICO, Fair Isaac Company. Fair Isaac has been around since 1989. 90% of the lenders out there use FICO. FICO's model to evaluate candidates. It's based on an algorithm and it has a number of factors. We're going to go over some of the factors in a second, but it puts less weight on unpaid medical bills and it doesn't penalize you for collections as long as you've repaid the amount in the collection, and it includes your rental history as part of your overall credit history. That's FICO.
Yeah, and then Vantage scores familiar data, things like paying on time and keeping credit balances low, avoiding new credit obligation, bank accounts, and other assets are calculated into the score to really kind of give you a little bit different model than FICO. It's not quite as widely used, but it is out there. So quick mention of that never hurts.
Yeah, so break down for me then. What's the difference? What's the components that make up the score? Payment history, credit utilization, length of credit. So break those down for us.
Yeah, so there's five out there. So we'll start with the first being payment history because it makes up about 35% of your FICO score, 40% of your Vantage score. So this is the big one. It's the record of your ability to pay and willingness to pay bills on time. So making your payments regularly and not being late on them or missing them entirely. The second, credit utilization, is the percentage of available credit that you have used. So if you have a $10,000 credit limit and you're using 9,000 of it, you're using 90% of all the credit that's available to you. So that's going to look worse than having $1,000 and only using 10% because you don't have anywhere to go if an emergency happens. You don't have a lot of credit still available for you to use. So it makes it less likely that you're going to pay back your payment. So this is about 30% of your FICO and 20% of your Vantage score. The next one is credit history. So the longer that you've had credit cards or loans, and the better that you're paying on time for, of course, the better your score will be for your credit history. And that's going to be 15% of your FICO and 21% of your Vantage score.
Good. And they also look at your credit usage, right? How many forms of credit you have open, how well you keep up with them, credit cards, mortgage, rent, auto loans. You ever notice when you call, Verizon and say, I want to switch from AT&T to Verizon, they say, well, we'll do the credit check first, because that's actually a credit relationship. And same thing with if you getting DirecTV. We just switched back to DirecTV, and they say that yes, you passed the credit check with flying colors. You can have this pricing on it. So those all go into the open forms of credit, and then new credit or credit checks. If you apply for several cards in auto loan, it kind of raises suspicion, right? So the banks look at that and say, hey, wait a minute, this person just opened up 3 credit cards with $25,000 limits on each. We can loan them money for the home equity line, and they could turn around tomorrow and max out those cards, and then they're not going to pay us. So those are some of the other things, the new credit and credit checks that go into your portfolio.
Yeah. And I think that a lot of people will get their credit score. They'll see a bunch of numbers and they don't really have any idea what those scores even mean. So, what are the ranges and what do they really imply for a borrower?
Yeah, the good thing is now most of the apps, the bank apps, will have a little button that says check my FICO score or check my credit score. And then the little needle will swing across to whatever their number is. And so the numbers run 300 to 499 is considered very poor. 500 to 600 is poor. 601 to 660 is fair. and 661 to 780 is good. Now we're starting to get into the sweet spot where you'll get the right loan from the car dealership or from, you'll get the better loan. And then 781 to 850 is considered optimal and excellent. But I will tell you, being in 781 to 850 my whole life, it doesn't mean dealing with banks is still not a pain in the neck. They still rake you across the coals for information. So, but you want to get in that 781 to 850 to know you're getting the best offers from the banks that are out there. And which, is a good time to say, explain to us the impact if you have that poor, fair, or good or excellent rating.
Yeah, so obviously this can make a big difference on your financial life, whether you're going to get approved even for a loan in the first place. If you're in that poor or fair range, you might not even be approved for a loan. Very poor, we won't even get started on. I can say you're probably not getting approved for that loan at all. But then when you get kind of that fair, good, excellent range, that's when you start teetering into the what rate are you going to get, because the lower your score is, they're typically going to charge you a higher interest rate just because you're considered a riskier investment in lending to. It's less likely that they're going to get their payments, so they're going to charge you a little bit extra for your quote unquote risk class that may not pay back. So the people that do end up paying back kind of even out with the people that do not. So something to consider. You want to have a better credit score if you're trying to get any loans, because it can make a pretty big difference in what your overall payment is, which I think, going back to the poor and very poor section, John, what are some of the practical tips for people that are either still building credit because they're young, or they're trying to rebuild their credit because they've had some issues in the past and
Yeah,
they've
I would
damaged their
say,
credit score?
yeah, I would say pay those cards down strategically. A lot of times, when we sit down and do a plan with someone and they're looking to get out of debt, they'll have 4 credit cards with 4 balances. And we'll look at the interest rate on the cards and we'll look at the balances on the cards and say, all right, these 2 cards we want to pay the minimum on. This one you want to pay an extra $100 a month. And this one we want to attack with all the extra money. So they were putting, maybe $500 toward each of 4 cards. We might switch that narrative so they're putting $1,200 on one card, 500 on the other, and 150 on the last 2. So, and as long as they're making those minimum payments and they're making them on time, it's going to be okay. And the credit company is going to see, there's a plan in place to eliminate cards. And then when one card's gone, they can redirect that $1,200 to the other card. So it's strategy. And we help with that with people, mostly children and grandchildren of clients that wind up in that credit card pinch early in life with, it's not just credit cards, it's student loan versus the credit card versus the car payment. How do we handle those? And then you got to be on time, because no strategy to improve your credit works if you're late. Late payments stay on your bill for 7.5 years, stay on your report. So.
Yeah, and I think the other thing that's worth a mention is getting credit for some of the other stuff that's not commonly reported. I think a lot of people don't realize that a utility bill, you can make an agreement with the utility company to have them report your payments. So just anything that you can get for them to report to the credit, as long as you're continuing to make your on-time payments, and that's the key there, is you don't want to start setting up an agreement with the utility company to report to your credit, and then you start missing payments and it just hurts your credit worse. So anything that you can get to report to your credit score while you're making on-time payments will continue to help, because it'll keep showing that track record of on-time payments and continue to improve your score, which is the biggest portion of a FICO score. So
Yep. And piggyback on that with what a secured credit card is.
yeah, I think secured credit card gets into that very poor section where you're not really getting the same approvals for credit cards or loans. So you need to repair your credit in some way, shape, or form. And I think that's when the secured credit card comes into play, is that you put a amount of money, you're basically paying your credit card off in advance, but it's rebuilding your credit. So you're not actually getting real credit. You're basically giving the credit card company your money ahead of time, like a debit card of sorts, but they treat it like a credit card. And as far as reporting to your credit goes, so you can start kind of rebuilding your credit while your money is acting as a collateral on the account that you're actually spending. So you're really just spending your own money, but it's guaranteeing payment over time because it goes on the card and then they instantly repay it back with the funds that you already provided to them. So just another way of building credit, but in a way that if you're not getting approved and it's hard for you to get any credit to raise your score, you can start somewhere and start rebuilding. So you might be able to get approved for a real credit card a little later on. So, kind of digging in a little bit more on that of poor credit scores, emphasize the importance of regularly reviewing your credit reports for errors, fraud, and just making sure everything looks right when you're
Yeah,
checking your credit.
this is a good chance to go back to what I said about the little gauge. When you open up the Wells Fargo app or the Bank of America app, you'll see that little needle slide over to 842, and all right, there I go. That's not checking your credit. That's checking your FICO score. Checking your credit is going to something like annualfreecreditreport.com, where you can see what Experian and all the others have out there, based on your actual available credit lines and cards that you're using. And so that's important to look at, because you could say, I didn't know I had that open still. Why is that? Why am I still sitting there with a $15,000 Discover available amount? And, when I shredded my Discover card years ago and I haven't got a bill from them. And so you want to look at that annual free credit report. You want to try to avoid the pay ones. Because there's a number of them out there that the ones that advertise they all charge. But once a year, you should get your annual free credit report from annualfreecreditreport.com and look it over, painstakingly, and make sure that everything looks right there. That I think is one of the better ways to really get into the weeds of what the banks, the car dealerships, everybody's looking at before they make a decision on what they're going to give you, as far as, like Taylor said, a rate offering. It's going to be based on what they see in that report. So I want to close with the myths and misconceptions. I'm going to have Taylor go over it, but there's one big myth we hear all the time, and Taylor's going to go over it today along with the other misconceptions.
Yeah, so I think the biggest one that we hear and see too often is that carrying a balance on your card actually helps your score, which people think out there, oh, it's great that I can show them that I can make a payment every single month and keep paying it, even if I'm carrying the balance. But people don't realize that, again, 30% of your score is the credit usage. So if you're using up all of your credit or a decent chunk of it by carrying a balance, not only are you paying the 15 to 30% interest on that for really no reason, but you're actually building up the amount of credit percentage that you have, and credit availability is now going down, and you're actually going to be hurting your score more that way. So that's the big one we see. And then the second biggest one is that closing a credit card improves my credit score, which is a big false myth that people think, oh yeah, I need to close out. I paid it all off, close it out. I don't want to use it anymore. But closing out a credit is going to shrink your credit usage. You'll have less credit available to you at that point in time. So it's better off to just keep the card locked away in a safe or in your wallet, but not using it, but keeping that credit account open because you have it available to you still. If it's an annual fee card or anything like that, that might be something you need to consider closing or calling the company and seeing if they could change you to a card that keeps your credit line open and balance available to you, but one that does not have an annual fee. But closing a card is more likely to ding your score because of having less credit available to you all of a sudden by closing it.
Yeah, and then the other myth that we get all the time from people is about student loans. Well, they won't affect my credit score. That's completely false. Your credit score is affected by all your bills, including your student loans, and they must be paid on time. So, well, that wraps another session of Financial Tides. We thank everybody for joining today. If you have any questions, just follow up with Taylor, myself, Josh, or any team member. Feel free to share the link to this podcast with anybody you think it may be pertinent to. And if you have any questions, as mentioned, just reach out to us. Thank you, folks.
Thanks so much, guys. Enjoy the rest of your day.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.